Every time a new global headline breaks, the same question quickly follows. Why haven't U.S. markets fallen apart? Geopolitical tensions, regional conflicts, supply chain disruptions, elections, and shifting alliances continue to dominate the news cycle. Yet despite this constant background noise, U.S. financial markets have shown a surprising level of stability. Volatility appears, but it often fades. Sell-offs happen, but they rarely spiral. Understanding why U.S. markets remain relatively stable, even in a highly uncertain world, reveals how deeply the structure of the U.S. economy and financial system has changed. One of the biggest reasons for this stability is diversification at scale. U.S. markets are not dependent on a single industry, region, or growth engine. Technology, healthcare, energy, consumer services, finance, industrials, and defense all play significant roles. When one sector faces pressure, others often benefit. This internal balance acts as a shock absorber, allowing markets to adjust rather than collapse when global risks emerge. Corporate adaptability has also improved significantly over the last decade. U.S. companies operate in an environment where disruption is no longer viewed as an exception, but as a constant. As a result, businesses are better prepared to adjust supply chains, manage inventory, shift sourcing, and respond to sudden changes in demand. This flexibility reduces the likelihood that global disruptions translate into immediate earnings crises, which helps stabilize stock prices. Another key factor is the depth and liquidity of U.S. financial markets. The U.S. remains the most liquid capital market in the world. During periods of uncertainty, global investors often move money into U.S. assets rather than away from them. This safe haven behavior supports equity and bond markets even when international conditions worsen. Liquidity allows markets to process bad news gradually instead of violently. The role of the U.S. dollar cannot be overlooked. As the world's primary reserve currency, the dollar strengthens during periods of global stress. While a stronger dollar can create challenges for exporters, it also attracts capital into U.S. financial assets. This inflow supports market stability and lowers the risk of sudden funding shortages that can destabilize other economies. Earnings resilience has become another stabilizing force. Many large U.S. companies generate revenue globally, but they are no longer overly dependent on any single foreign market. Revenue streams are diversified, and cost structures are more flexible than in the past. Even when international demand softens, companies often find ways to protect margins through pricing, cost controls, or shifting focus to stronger regions. Investor behavior has also evolved. Institutional investors, pensions, and long-term asset managers now dominate trading activity. These participants tend to react less emotionally to short-term headlines than individual traders. Their focus on long-term allocation, income generation, and risk management reduces panic-driven selling. As a result, markets may react to global shocks, but they recover more quickly. Another important factor is expectations. Markets are not reacting to uncertainty itself, but to surprises. In today's environment, uncertainty is expected. Geopolitical tension, trade disputes, and political shifts are largely priced into valuations. When risks are widely anticipated, their actual impact on markets is often muted unless conditions worsen beyond expectations. Monetary policy credibility also plays a stabilizing role. While investors may debate the timing of rate cuts or hikes, the Federal Reserve's commitment to maintaining financial stability provides confidence. Markets believe that policymakers will respond if systemic stress emerges. This belief reduces the likelihood of self-reinforcing panic during periods of global tension. Technology has also changed how markets absorb information. News travels instantly, but so does analysis. Investors can process data, assess exposure, and adjust positions in real time. This reduces uncertainty around uncertainty itself. When investors understand where risks are concentrated, they are less likely to sell indiscriminately. Risk management practices within corporations and financial institutions have improved as well. Stress testing, scenario planning, and conservative balance sheet management are more common than before. Companies carry more liquidity, extend debt maturities, and avoid over-reliance on short-term funding. These practices reduce the chance that global disruptions trigger financial distress at home. The U.S. consumer remains another stabilizing force. While spending patterns fluctuate, consumer demand has proven more resilient than many expected. A large, relatively stable domestic market allows U.S. companies to rely less on international growth during periods of global slowdown. This internal demand supports revenue and earnings even when external conditions weaken. It is also important to note that stability does not mean the absence of risk. U.S. markets still experience corrections, rotations, and periods of volatility. Stability means those movements are typically absorbed without cascading failures. The system bends, but it does not break easily. Global uncertainty can even reinforce U.S. market strength. When conditions worsen elsewhere, capital often flows into U.S. assets by default. This dynamic may not eliminate risk, but it shifts where risk is concentrated. Compared to many other regions, the U.S. benefits from institutional trust, legal clarity, and transparent markets. Looking ahead, the stability of U.S. markets will continue to be tested. Geopolitical tensions are unlikely to disappear. Economic cycles will turn. Policy decisions will create winners and losers. But the underlying structure supporting U.S. markets remains intact. The key lesson is that stability is not accidental. It is the result of diversification, liquidity, adaptability, and credibility built over time. U.S. markets are not immune to global uncertainty, but they are designed to function within it. In a world defined by constant disruption, the relative stability of U.S. markets reflects a system that has learned how to absorb shocks rather than amplify them. That resilience, more than short-term optimism, is what continues to anchor investor confidence despite an unpredictable global backdrop.